cut today, and that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates, and the idea that this new easing cycle is going to propel the market higher, just like prior easing cycle. And I've known that there was going to be a lot of bumps on this road, because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claiming that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, he said in the Q&A that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell even indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, one less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to, 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed about 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about growing deficits. In fact, they have this continuing resolution that is working its way through Congress now to keep the lights on, and that includes $110 billion of new spending in addition to all the other spending. An extra $110 billion. Also, they threw in a raise. I guess the Congress and the Fed, they haven't gotten a raise in the last 10 years, so they slipped the pay hike for themselves into this continuing resolution. But that alone adds another $110 billion to the debt over the next year, in addition to everything else that's added. They're talking about DOGE, commission, but spending. They're already increasing it beyond where it already was. And in fact, the House of Representatives passed this Social Security charities. Who's going to be against Social Security charities? But what it does is it increases benefit to civil service workers who are getting less benefits now that we're going to change that, so they get full benefits. That costs an extra $20 billion a year. Just throw that onto the pile. And of course, if they estimate $20 billion a year, it's probably going to cost a lot more than that. But these guys are still adding on new government spending as deficits are exploding out of control. So the bond market is concerned about this. Now, I think it would be a lot worse for the bond market if the dollar was falling, but it's not. The dollar surged today to a new 2-year high, dollar index above 108. The euro, I think, is down to 103. Let me check where it is. The euro is trading at just under 104. So 103 and 3/4. It's up a little bit in the evening. It was at 103 and a half. But dollar index above 108. So the dollar is soaring. It's the only thing that was up today was the dollar. Everything else stock market, the bond market, you know, the Russell 2000 was down better than 4% on the day. And, you know, the Russell 2000 is now down 1% since Trump was elected. A couple of weeks ago, it was up 9%. So we've had a 10% decline, now a full-blown correction in the Russell 2000. The QQQ was down, that's the NASDAQ 100, was down 3.6 today after hitting a record yesterday. In fact, several NASDAQ stocks had some pretty big reversals today where they hit new highs and then they got clobbered later in the day after the rate hike. But everything was down except the dollar. Gold was down about $60 an ounce today, up about $10. Now it's up $30. I don't know. So now it's back up at 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago, and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But you know what's amazing? The gold stocks again got absolutely hammered today. Right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but now 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. Yeah, it's not the 30% that it was, earlier. But 25% up is a hell of a year. One of the best years for gold. And these stocks are down. Now, it wasn't too long ago, before Trump was elected, the gold stocks were up more than gold. Now, they weren't up a lot more, like they should have been, but they were up more. But since their peaks, even though gold is only off 7% as of earlier today, Barrick Gold is 35% below its high. 35%. Newmont Mining is down 33%. These stocks are trading at less than 12 times earnings. So what does that tell you? About the sentiment. They're less than half of the market multiple. Hey, I'm having these technical difficulties. I was trying to text, so Paul, you got to let me know when to do the commercial break, because you didn't give me a timer, so I have no idea how long I've been talking. So you got to send me a text and let me know when I need to break. I was hoping to do that without having to say it, but anyway, that's what I had to do. So where was I? Yeah. So the fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive it is in everything else, right? Because it's the mirror image. You have crazy optimism on the overall stock market, ridiculous optimism in Bitcoin, but extreme bearishness, extreme pessimism in gold. Now, what investors don't understand, what the Fed doesn't understand, and I'll get to that. I'm going to take a quick break for this commercial. I'm going to come back and I'm going to talk about what it is that the Fed and investors don't understand. So stick around. I looked at the press conference and dissecting some of the things that he said. The main reason that Jerome Powell has so much confidence in the Fed's ability to slow down on the rate cuts is because Powell is convinced, and I guess everybody else on the Fed, that we've got a fantastic economy. I think he described it as remarkable. We've got this remarkable economy with a very strong labor market. This is what Powell believes. And so he doesn't think that the economy needs these rate cuts to support it. And so he can keep fighting inflation. But Powell still doesn't understand that the economy is not strong. It's not strong at all. When he was asked in the prior press conference, or Alan was a press conference, maybe I was a press conference, if he learned anything from the election, and he refused to comment because he didn't want to talk politics, because there really wasn't a real question. But what Powell should have learned from the results and the exit polls from the election is that the economy is not strong. Because the people living in the economy told everybody that the economy was weak. They voted for Trump because the economy was weak. If the economy was strong, they would have voted for Kamala. But they didn't. They voted for Trump. Also, one of the reasons that Powell thinks the labor market is strong is because of all these jobs that they've created. Well, most of them have been eliminated from creation because they were never created in the first place. Powell is completely ignoring the massive downward revision in prior payroll numbers and more downward revisions in companies. And they're ignoring even more bad economic data that came out this week. In fact, one of the data points that came out this week that nobody even talks about is the current account deficit. This is for the third quarter of 2024. Our current account deficit for the quarter was $310.9 billion. That's a record. We've never had a current account deficit that big in one quarter. We blew through the record from Q1 of 2022. And this is a record. And it's going up. Look, wealthy nations have current account surplus. Right? You look at Japan, Germany, China, Switzerland, Singapore, all these countries, Scandinavian countries, they're wealthy countries. They all have current account surpluses. Only the United States. Well, I think Great Britain has a deficit. They're pretty screwed up over there. But all the real wealthy countries have current account surpluses. America, at the height of its economic power, we have the biggest current account surplus of any nation. So normally, a current account surplus and being a strong, wealthy economy, they go hand in hand, right? It's like a real scorecard of your economy. Are you generating a profit or are you operating at a loss? Right? It's like a P&L on a nation. You want to have a current account surplus. That includes your trade position and your net investment position. What makes up the current account are goods, right? We have a huge deficit in goods. But we also have a deficit in net income. What that means is that foreigners earn more money on the investments they have in America than Americans earn on the investments that they have abroad. And so we're just a two-time loser here. And we've got this huge current account deficit. Multiply that out by 4. If we keep doing that, that's $1.2 trillion a year of red ink hemorrhaging out of the country. And they're saying that we got a strong economy. So we got a remarkable economy. What's remarkable is that we can even survive with this enormous current account deficit. Any normal country would be having a currency crisis and a bond crisis if they put up numbers like this. But we get a pass. We can get away with it because of the status of the dollar. If euro is going up once again, we have the dollar rallying. That means we've got more rope to hang ourselves. That's exactly what we do. We run even bigger deficits because our overvalued dollar allows us to do that. But another thing that's going to happen with the strength of the dollar, which I believe is temporary, but it's going to be temporary for a while longer. This is going to put a lot of upward pressure on inflation in Europe, in Japan, in South America, in Canada. Look at the Canadian dollar. Look at the Australian dollar. These currencies are getting decimated. That's going to put a lot of upward pressure. So these countries have been cutting interest rates because their economies are weak. Well, now they're going to be getting strong inflation. So we're actually really exporting inflation around the world. As the dollar is strengthening and other currencies are going down, that means all these commodity prices are moving up. Oil is not moving up for us. It's getting a lot more expensive down under, and north of the border in Canada. So you're going to see upward pressure on inflation in their countries that are now cutting rates because the economy. Well, now we're in a that inflation is going to get so much stronger. You're going to have to start tightening policies. There's going to be a lot of pressure on worse. I mean, all these inflation are coming home to you, but they're coming home here too because interest rates, I think, are going to keep rising, and the stock market is going to keep falling. I think we could have entered a bear market. This could be the beginning of it. I even posted that on X yesterday. I said, this could be the top of starting the bear market because there was so much crazy volatility. Nobody thought the market would go down, which meant that's probably what was going to happen. There was every reason to be bullish and no reason to be bearish according to the mainstream, which is easier of itself to be bearish. But we get a bear market in stocks, that's the first wealth effect. Long-term rates go up, mortgage rates are about to spike up, and this is going to be another negative for the housing market. I can already feel some cracks building in the banks. Everybody was expecting a rate cut. We get new highs. We move back above 5%. And I think we're heading to 4.5 now. So we could be up to 5% very quickly. We could be looking at more Fed bailout. And I can also imagine if Donald Trump is coming into office, he's not going to like it walking into the airport. He just went down to the New York Stock Exchange and rang that bell. So excited. Look at the Dow Jones barometer of his presidency, and he's going to see the market tanking. That's not going to be something that he's going to be happy about, especially if the Fed is taking the punch bowl when he wants to spike. Now, so there's going to be some fire there between ISIS and Trump. Because Trump, of course, is going to want easier money to prop up that market if it's falling, and to prop up the whole economy. If things start to go south, which they probably will, and the Dow is talking about interest in the economy, so the whole thing could be downward high, right side. I think he's got to be ego. He doesn't want to admit that the economy is that would be an admission that he's up. That's one of the things he said. Hey, I get that. But, he was bragging about how much progress was made in reducing inflation and how little damage has been done to the economy. He said, look, nobody thought we would get inflation this low, even though it's not down to 2, it's 2.5. Nobody thought we could get this low without causing a recession. And look, we did it. No, he didn't do it. They did cause a recession because we're already in one. We've been in one for a long time. It's just that they haven't done enough revisions in the data to reveal it. But the voters knew that we were in a recession. That's why they voted for Trump. That's why they told the exit poll people, I voted for Trump because the economy stinks, because inflation is too high. And in fact, Powell, he dismisses it. He says, well, the reason people don't like inflation is because we had a huge increase in prices. Yes, thanks to your policy. And he says they haven't come back down. Of course they haven't come back down. And so he says people are upset because it's going to take many years for their wages to catch up to prices. Yes, then why did you let this happen? Why, Jerome Powell, did you let the inflation genie out of the bottle? Why did you say that we need to let inflation run hot to make up for all the years that it was slightly below 2%? Right? Well, now look at it. Right? And now it's going to take a couple more years, even according to the Fed, before inflation goes back down to 2%. And that means that prices are going to keep rising, probably more so than wages. So we have a weak economy. I think the Fed is taking false credit for having engineered this miracle that is going to unravel before their eyes. But there's going to be a lot of pressure, I think, from the incoming administration on the Fed to stimulate and do something to prop up the economy, to prop up the markets. And again, I think the only reason that Powell is talking tough on fighting inflation and indicating that, hey, they said that it was a tough call, that maybe they weren't going to cut 25 basis points. And in fact, if you listen to what Powell said, it made no sense to cut at all. And it makes no sense to even indicate that more cuts are coming. I mean, he still said that, we're probably going to cut rates in 2025, even though inflation is higher than we thought, and even though it's headed back in the wrong direction. If that's the case, they should be basically taking all rate cuts off the table. He all but took rate hikes off the table. One of the questions that he got in the Q&A was if the Fed would consider, or are they going to take off the table a rate hike? I think that was, are you going to take out of consideration, or can we at least know that we're not going to get a hike next year? And Powell said, well, I'm not taking anything off the table. But he said that that's not our intention, or that's not our base case, or something like that. He says, look, I don't think we're going to be hiking rates, but I'm not taking a hike off the table, right? The market didn't want to hear that. The market wants to hear, oh yeah, there's no way we're hiking rates, but he doesn't think he will. He should be hiking rates. Now, I agree, I don't think the Fed's going to hike rates. I think the Fed's going to cut rates next year. They're probably going to cut rates more than 50 basis points. Now, I don't believe they're going to be able to get all the way down to zero. But if they have to do that in order to restart QE, then that's what they're going to do. Because that's the big change. QE is coming. And it's coming despite